You open your phone in the morning, still half asleep, and the first thing you see is red. Not a little red, a lot of red. Prices are down, charts look like ski slopes, and suddenly every crypto influencer you follow has a shocked face in their thumbnail. Your portfolio feels lighter, but not in a good way. Panic starts creeping in. And while most people are asking themselves, should I sell before this gets even worse? Something very interesting is happening behind the scenes. The biggest players in the market, the so-called whales, are not panicking. They're buying. Quietly, methodically, almost casually. And that leads us to the big question. Why do whales always seem to accumulate during crashes? At first, this behavior feels completely backward. Common sense tells us that when something is going down, you stay away from it. If a building looks like it's on fire, you don't run inside. So why would whales run toward a crashing market while everyone else is running away? The answer isn't magic, insider knowledge, or secret group chats. It's mindset, experience, and time horizon. Before we go any further, let's quickly clarify what we mean by whales. In crypto, whales are people or entities that hold large amounts of a cryptocurrency. These can be early Bitcoin adopters, long-term holders, investment funds, institutions, or companies. The important part isn't the exact amount they hold, it's how they think and operate. Whales don't trade the market the same way beginners do. They're not glued to 5-minute charts. They're not checking prices every 10 minutes while pretending they're just curious. They play a longer game. Now let's talk about crashes themselves, because understanding what actually happens during a crash explains a lot. When prices start dropping, fear spreads fast. Liquidations kick in. Leverage gets wiped out. People who borrowed money to chase gains are forced to sell. That selling pushes prices even lower, which creates more fear, which creates more selling. It's a feedback loop. Meanwhile, the news amplifies the panic. Headlines become dramatic. Suddenly, it's not just a dip. It's the end of crypto as we know it. This environment is overwhelming, especially for beginners. Here's the key difference. Retail investors experience crashes emotionally, while whales experience them strategically. For many beginners, a crash feels personal. It feels like a mistake, like proof that they were wrong. Whales don't see it that way. They've been through this before. Many of them have lived through multiple cycles: bull markets, bear markets, bubbles, and collapses. When prices fall, they don't think, this is over. They think, this is familiar. One of the biggest reasons whales accumulate during crashes is that they understand the difference between price and value. Price is what the market is offering today. Value is what they believe something is worth over the long term. During crashes, price often disconnects from value because fear takes over. If the technology still works, the network is still active, and adoption hasn't disappeared overnight, then a lower price doesn't necessarily mean lower value. To a whale, that gap between price and value is opportunity. Think of it like a store-wide sale. Imagine your favorite item suddenly goes on a massive discount because everyone else thinks it's out of fashion. If you believe the item is still useful and valuable, you don't panic. You buy more. Crashes are basically Black Friday events for long-term investors. The problem is that fear makes most people forget why they liked the asset in the first place. Another important reason whales accumulate during crashes is liquidity. When markets are booming and prices are flying up, it's surprisingly difficult for whales to buy large amounts without pushing prices higher. There just isn't enough supply at reasonable prices. During crashes, the opposite happens. Sellers flood the market. Liquidity increases. That allows whales to accumulate large positions without causing huge price movements. In simple terms, when everyone wants out, it's easier for big players to get in. There's also a psychological advantage that whales have: emotional distance. Most whales aren't investing money they need next month. They're not worried about paying rent with their crypto portfolio. That distance allows them to think clearly when others can't. Fear is loud. Panic is contagious. But whales are less exposed to those emotions because their decisions aren't tied to short-term survival. So time is another massive factor. Whales think in years, not weeks. When you're operating on a 5 or 10-year timeline, short-term crashes become background noise. They still matter, but they don't define the strategy. A 30% or even 50% drop looks very different when you zoom out. This long-term thinking also explains why whales don't chase hype. When prices are pumping and everyone is euphoric, whales are often quiet. Sometimes they sell into that excitement. Sometimes they just hold. But when prices crash and nobody wants to talk about crypto anymore, that's when accumulation happens. It's boring, it's uncomfortable, and it doesn't feel rewarding in the moment. But markets don't reward comfort, they reward discipline. Now let's bring in some data, because this isn't just a nice story. On-chain data has repeatedly shown that long-term holders and large wallets tend to accumulate during downturns. We often see coins moving off exchanges into long-term storage when prices are low. That suggests confidence, not fear. It doesn't mean prices will instantly recover, but it does mean that the people with the most experience aren't giving up. That said, it's important to clear up a common misunderstanding. Whales are not always right. They don't have perfect foresight. They can be early. They can underestimate how long a downturn will last. But here's the difference. Retail investors often confuse being early with being wrong. Whales are okay with buying early and then waiting patiently while the market catches up. Risk management also plays a role here. Buying during crashes can actually reduce long-term risk if done correctly. When prices are already down significantly, a lot of bad news is already priced in. Expectations are low. That doesn't remove risk, but it changes the risk-reward balance. Whales don't eliminate risk. They choose when the potential reward justifies it. There's also the myth that whales are constantly manipulating the market, pushing prices down on purpose just to buy cheaper. While manipulation can happen in certain situations, the reality is much less dramatic. Markets move because of leverage, liquidity, sentiment, and macroeconomic forces. Whales aren't controlling every candle like some kind of secret villain club. They're reacting to the same market conditions, just without panic. So what can regular investors actually learn from this? The goal isn't to copy whales move for move. Most people don't have their capital, patience, or risk tolerance. But you can learn from their mindset. Whales plan ahead. They decide what they believe in before the crash happens. They don't make decisions in the middle of chaos. They spread their buys over time instead of going all in at once, and they accept uncertainty as part of the game. One of the biggest mistakes beginners make is letting headlines dictate their actions. When things feel calm, they feel confident. When things feel scary, they panic. Whales flip that relationship. They become cautious during euphoria and curious during fear. That doesn't mean fear disappears. It means fear doesn't control the decision. Another lesson is understanding cycles. Markets move in cycles. Boom, bust, recovery, repeat. Crashes feel unique when you're inside them, but history shows that they're part of the process. That doesn't guarantee the future will repeat perfectly, but it provides context. Whales use that context to stay grounded. It's also important to be realistic. Whales can wait longer than most people. They can handle volatility better. That doesn't mean everyone should try to act like one. The smartest move for a beginner isn't to chase every dip, but to build a strategy that makes sense for their situation. Even understanding why whales accumulate can help you avoid emotional decisions you might regret later.